Hey everyone, my name is Jack, and in this video I want to go over how a home equity line of credit works. A home equity line of credit, or HELOC for short, is one of the most flexible financing options in real estate. It's basically like a gigantic low-interest credit card that's attached to your home. There are a lot of advantages to using HELOCs, and they can make a lot of sense in a variety of circumstances. But there are a number of disadvantages as well, which we'll go over shortly. Whenever you're picking a debt product, it's important to understand how it compares to other debt products that might be available so that you can make the best choice for your situation. Most lenders will allow you to take a HELOC up to 80% of the value of the property, minus any outstanding mortgages that you already have on it. You also will have to meet lender debt-to-income requirements or any other underwriting requirements that that lender might have. As an example, let's say you own a $300,000 home that currently has a $170,000 mortgage on it. Your maximum debt load on the property would be 80% of $300,000 or $240,000. This means that you would be eligible for a HELOC of up to $240,000 minus the $170,000, which gives you a total of $70,000. That $70,000 can give you a lot of flexibility and carries a lot of advantages over other types of debt. One of the biggest advantages that comes with the HELOC is its unique flexibility. When you take out a HELOC, you get a predefined limit, but you can use any amount up to that limit, whether you need it all or a lesser amount. It's not as though you are taking out a huge balance at the beginning if you don't want to. This allows the borrower to stay very flexible in that they can just take out a little bit of the HELOC or all of it if they need it for a certain project or if it makes sense to invest with it. Another big thing that makes HELOCs very flexible is that they are revolving. This means that when you pay down the balance on a HELOC, you can take out that balance again as though it was never closed because the HELOC is open for the term of the loan. This is different from a fixed 30-year mortgage, for example, where after you pay off the balance, that's it. It's not as though you get to draw any more money to use again. You'd have to go to the bank and open up a whole new loan. That's not the case with HELOCs. The revolving nature of HELOCs also saves a lot on closing costs, since you don't have to go to the bank and reopen a whole new mortgage just to get the money that you need for a certain project. You can just go to your already open credit line, just like you would with a credit card, only this time it's on a much larger scale and at a much lower interest rate since it's attached to the property. This brings me to the next advantage of HELOCs in that they have much lower interest rates than your typical line of credit. Most credit card rates hover between anywhere from 18% to even 26%, if not more, in annual interest. HELOCs, on the other hand, typically have rates that follow the 30-year mortgage rate, plus or minus a few percentage points depending on how the fee structure is. This makes HELOCs a potentially very powerful tool for replacing existing debt that might have a much higher interest rate. Let's say you have $10,000 in credit card debt at 18% interest. If you take out a HELOC at, say, 4% variable interest, you just throw that HELOC on it to replace that debt, and all of a sudden your monthly payments have become a lot lower. This brings me to the disadvantages of a HELOC, the first one being that they are typically variable rate interest. Even though your HELOC rates might be very low to start, since they're variable, they could change at any time depending on the terms of your loan. Using variable rate loans is inherently more risky than fixed rate loans, since at any time the market might change or your interest rates may go up even when you already have a balance open. So your monthly payments can actually grow even as you attempt to pay the balance down depending on the circumstances. Typically, banks will peg the variable rate to the prime interest rate, which is the rate that banks get when they lend to one another. Again, just to reiterate, even if your rate starts low with a variable interest HELOC, it could inevitably become much higher than you may have ever intended because the market might change and your interest rate terms might kick in. Another disadvantage with HELOCs are fees. Sometimes when you open a new HELOC, there may be some hefty fees at the start. Or you might have an annual fee, much like a credit card, that you have to keep an eye on. Sometimes this can be in the hundreds of dollars. You have to be very careful when you're evaluating which HELOC to take out as a result. Thankfully, some lenders have very low fees or no fees at all, at least for the first few years with HELOCs. So it's worth exploring your options if it's a product that you're willing to consider. Another disadvantage that certainly cannot be overlooked with HELOCs is the fact that it puts a mortgage or potential lien on your property. This is the whole reason that you can get such a low interest rate compared to credit cards, because the bank has a secured interest to your home. This means that if you don't pay off the HELOC, the bank gets a much higher position if you were to foreclose, and they'll get paid first whereas with a credit card, they might be in the back of the line behind someone who has a secured interest. In short, the lender's just getting a better position to where they can get paid more easily because they have a lien attached to your property in foreclosure. In layman's terms, what this means is that if you don't pay your HELOC, they're going to come after your home. Just as with any debt, it's always important that you at least meet the minimum payments to avoid not only dinging your credit score, but also putting your home on the line or any of your other assets. You don't want it all to come toppling down just because you aren't making the simple monthly payments. Another disadvantage of a HELOC is the temptation that having a large line of credit comes with. With HELOC, ultimately you can use the funds for whatever you want. But no matter what you spend it on, you are definitely going to have to pay the balance back, just like with a credit card or any other debt instrument. That debt does not go away once you spend it. You will have to pay it back in time. Always tread carefully when using any amount of debt, especially when it's attached to your home. So now that we understand the advantages and disadvantages of HELOCs, when does it make sense to take one out at all? In addition to debt consolidation and lowering your interest rate on your existing debt, like I mentioned before, HELOCs can also make very powerful investment tools. Many real estate investors often use HELOCs to finance rehabs or even the initial purchase of rental properties before they refinance into a first mortgage after that to pay back the HELOC afterwards. This allows an investor to buy a property or finance a rehab very quickly rather than having to run to the bank to get a whole new mortgage right then. It buys them time in a way. HELOCs are often also used for large but necessary purchases. Just as with any debt, you probably shouldn't buy luxury items with it since you're paying interest on something that you don't already need. Maybe you have a hospital bill that came up that's going to be hard to cover with cash, if not impossible. You can tap into your HELOC as a sort of emergency fund if you want to look at it that way. But again, you're always going to have to pay it back, so it's not as though it's free money. It might also make sense to take out a HELOC when a recession is looming. Because your property value might be at its highest, as it has been in many years, might make sense to take out a HELOC to essentially lock in that equity so that you can use it for purchases or investments later. Whenever you're in doubt about what debt you should take out, I recommend looking to a licensed financial professional to find the strategy that's best for your needs. In conclusion, HELOCs are a very flexible debt instrument. They allow a person to reuse the equity in their home over and over to make investments or any other purchase for whatever they want. With sensible risk management, HELOCs can be a very potent tool for getting towards your financial goals and making your financial situation that much better. But as with any debt, with great power comes great responsibility. I hope this video helped you to understand the advantages and disadvantages of using HELOCs and how they work in the first place. If you like this video, be sure to give it a like. It helps the channel out a lot. If you have any questions that went unanswered, be sure to leave a comment below. Until next time, take care.